Hello investors, my name is Gary Luna and this is Grant Haddon. Adam Carlini also is with us. Today is Friday, July 29th. Good to be with you. We thought we'd put together a quick video as we finalize July here, just a couple more days, and we're starting to get into the weekend. We thought you might be tired of all the political conventions going on. Maybe we'd give you something else to look at. So we have a quick video for you, give you an update of what's going on out there.
Yeah, the market's been doing well, so we have good news today. The market's gone up and it's actually holding its ground up there, so we'll be happy to jump in the charts and show you all about it. Alright, welcome to our market update for July 29th, 2016. I want to start by just reminding you that we are taking a break from our major events, our seminars and breakfast club meetings, but we are going to start those again soon. Look for dates on that on our website. We're going to be starting in early September for both. Okay, here's our risk indicator. We've been green for a long time, and we like that. That's how we would prefer things. As long as this needle is over here in the green zone, then we are allocated in a more aggressive manner, more equities than defensive holdings, meaning that as this market has ran up, we have participated and we've enjoyed that. So Gary's going to jump more into the more specific details of the stock market and the charts, but we have been green for quite some time and are still green and have a good cushion up there. Real quickly, a couple economic events that we want to talk about. So the first one is the real GDP growth. So we just recently, today actually, had this report come out, and the GDP came out at 1.2%, which is actually a sluggish number, not very impressive, but there's a silver lining that actually the consumer spending was 4.2%, which is more than a double of the first quarter. So that is really the positive news, and that's why today the stock market didn't get shaken up by this low GDP number. It stayed in there and hung in there, mainly because, in our opinion, because the consumer is still around and actually increasing. So the market is probably pricing in an increase in GDP growth for the next upcoming quarter. Here's a chart of new home sales. As you'll notice, they've been steadily increasing, which is another positive. And they've been increasing as mortgage rates have been coming down, so it's more attractive to people to buy homes rather than to rent. And actually the number that just came out, this is a number for June, but it came out on Tuesday. It came out that there was 592,000 new home sales, which is much higher than expected, which is a great sign for the economy. The consumer is still around. There are consumer spending is increasing. Home sales are increasing. Those are all good signs that help us feel comfortable in the green zone. With that being said, I'm going to turn some time over to Gary and let him jump into the stock market charts.
Okay, Grant did a great job of getting us into our update. Let's go ahead and start looking at the stock market and some more specifics on this rally that we have been on. What you're looking at is a chart that is year to date, and it shows the major U.S. indices, the Dow, the S&P 500, the Russell 2000, which represents small caps or smaller companies, and the NASDAQ, which is heavily weighted in tech stocks. As you can see, as of the end of June here, the markets, each one of those indexes, have been on a good rally. And the other thing that's good to see about the way the rally has turned out is that notice that the Russell has really led us up. So relatively speaking, the Russell is stronger, has been stronger in this rally than the other major indexes. Again, that's good to see because of the fact that the Russell being the more aggressive index, we like to see that lead us on the upside. And so year to date, with all the choppiness that we've gone through, the Russell is now up about 7.4, followed by about 6.3 and 5.7 for the Dow and S&P respectively, and the NASDAQ lagging at about 3. But positive all the way across. So if you've been in this market, you're finally getting compensated for all the choppiness and all the back and forth throughout the beginning part of the market. or beginning part of the year, I should say. Let's take a look at July. So these are numbers just for July, and we're going to look at different sectors within the market. And what we're trying to determine here is, has it been more of a risk-on or a risk-off month? As you can see, as we look at major equities from U.S. to international equities to REITs, real estate, to high-yield bonds, all of those are nicely positive for the month of July. Now, we still have, we're just finishing out July actually in the next couple days. And the good thing also is that even our defensive positions in bonds have really not given money back. So equities have gone up, but really hasn't been at the expense of bonds. So they have held their own still. Gold's still up for the month. The thing that is down, and down quite a bit, is commodities. And the reason is mainly oil. And so we'll talk about that. But oil quietly has taken a drop again, and we'll look at that here in more detail. But we'd have to say for the month of July, definitely more of a risk-on month, and that's why, per our allocation, we're happy, and it kind of worked well that we were already more on the growth aggressive side, so our clients have been compensated for the added risk that they have been taking throughout the month of July. Let's take another look at that, just looking at the S&P 500. And here is that strong move as we finalized June and we got into July. We finally broke above this level of about 2100 on the S&P 500, which had held us down once, twice, 3, 4, and even going back further, which we can't see anymore on this chart. So the fact that we now broken above here, that is a great sign technically. Now notice over the last couple weeks though, a lot of sideways movement, and that's okay. After you have a strong move up, it's okay to go sideways. And the fact that we're not giving it back and then we're not going back down to these levels, at least not now, that is also a positive, and yet we're still above the 10-day moving average. So we like all of those things, and some sideways action here is probably a healthy thing as we consolidate, and hopefully the next step is another move up. We'll let the market dictate that, but that is a very strong move into July so far. Let's touch on what's bringing commodities down, at least one of the major sectors that pushes commodities, and that is energy or oil. So right at the beginning of June, oil kind of hit its near-term high at 51.67 per barrel for oil, per barrel price of oil, I should say. Where are we now? Somewhere around 41.14. So over the last 8 or 9 weeks, because every one of these marks is a week in time, that represents a drop of about 20% very quietly for oil. And as you can see on this particular indicator down here, the producer price oscillator, this represents a change in the longer term trend. So will that continue? And where will oil end up? The good news is we do not hold any major positions in oil. We do have some oil positions within the S&P 500. Obviously, that's one of the sectors in the S&P 500. But we don't hold oil heavily anyway, nor do we plan to do that. So that is something to be watched. And one of the reasons that has happened is the dollar has continued to strengthen, and obviously the inverse relationship between the dollar and the price of oil in all commodities. So back to our allocations, they haven't really changed a whole lot, although we've tweaked them over the last few weeks. We have not changed our allocation between stocks and bonds, at least not over the last few weeks, and we have been compensated for that. As you can see by this main chart, which again, what you're looking at is every one of these marks represents a ratio between stocks and short-term bonds or cash, meaning that when price action is more on the stocks side, or stocks are favored, we expect to see this chart go up, and that's exactly what has happened over the last 4 weeks. In fact, nice big bounce And we are now, as we said before, all-time highs for the Dow, for the S&P 500, not for the NASDAQ, nor for the Russell 2000, but that is okay. We'll take that on the other two major indexes, and we will stay on the bullish side. A little pullback would be expected, but as Grant said, we have a pretty good cushion now between the zones, and we will stay green and let the market jiggle around here for a little bit. Hopefully it settles down after going sideways and we start another leg upwards, but we will let the market dictate. If, however, it dies down again and we surpass these key levels, we have no problem getting into the neutral zone and pulling back on risk if we need to. That is the key on our trend ETF model. So that's basically all we had for you. Again, here is a reminder of how we run that particular model. We have three major client risk tolerance profiles: growth, moderate, and conservative. So the client that is a moderate client right now is holding an 80-20 mix in the green zone. If we break down and get into the yellow zone, then we would take 40% of those assets and move them to the conservative side. If the market were to further break down, of course, we could go 100% completely defensive. But again, we're in the green zone. We've been there for a number of weeks, and it looks like we're being compensated for that added risk that we're taking. And we have no problem staying there and tweaking things as we go along. But the major percentages of risky assets and defensive assets have been to our favor, at least recently, so we're happy about that. That finalizes our video. Again, remember that for those who are newcomers, the information that we're provided is in no way a solicitation to buy or sell any particular investment. Obviously, we do not know your specific situation, and this video is intended to update you in general on indexes, asset classes, and our view of the economy in general and so forth. If you have any specific questions, give us a call at the office, and we'd love to sit down with you at 623-466-6060. Until we talk again, you guys have a great week and a great weekend.